All right, welcome everyone. I'm Robert Baharian, and this is our first episode for 2022 of the Wide Lens podcast. I'm joined here with my good colleague, Matt Rigby.
Hello.
Matt, say hello to everyone.
Hello. How are we?
And what we're going to do is we're going to talk about and cover in this weekly podcast the hottest topics in financial markets, and we'll provide our personal and our own opinion and perspective on the topics that we're going to cover. We've got a whole bunch of stuff to cover this week. We, in fact, did start putting our notes together earlier in back end of December for this episode, and we threw that all in the bin and we started again because so much has changed over the course of the last couple of weeks. So, look, let's get straight into it. 2021, Matt, we saw tech just go absolutely berserk for 2020, 2021.
Again.
Interestingly, tech was not the best performing sector in the market, which we'll get to in a moment. But the narrative we've been hearing and seeing on the headlines and by commentators is that this stock market is so narrowly focused and driven by a handful of companies.
Yeah, it's interesting, and you touched on it earlier. We'll have a look at the sector returns, and they certainly tell a very different story.
100%. Look, Bloomberg had this article where they talked about the stock market is too narrowly focused. When just a handful of companies lead equities higher, trouble often follows for investors. The 10 largest stocks by market capitalization account for 30% of the S&P 500 index total value. And 5, Apple, Microsoft, Nvidia, Alphabet, and Tesla accounted for about a third of the index's 27% gain in 2021. In short, they go on to say, if anything goes wrong with that handful of equities, as well as managed and ETFs based on the broad market, everyone might be in trouble.
Yeah, and look, I guess, when companies are doing well, their share prices do well, and the index, when they account for such a large portion, the index follows. So, Apple, Microsoft, Nvidia, Alphabet, Tesla, I mean, they've all had spectacular 2-3 year periods. So,
and rightly so. Like we talked earlier about the top 5 stocks in Australia, which make up 28.4%. Top 10 stocks in Australia make up 43% of the market cap of the ASX 200.
Yeah, I mean, so the concentration discussion in the US is almost comical because we're pretty used to it down here.
But everyone, even in Australia, talks about it as if it's this big wild thing. Meanwhile, if you actually open your door to your own backyard and had a look, you're sitting at 43% of your top 10 stocks. Yeah. The thing that I am not sure how many people have done, and we've run the numbers and had a look at the S&P 500 market cap return over the 2021 calendar year versus that of the equal weighted index of the S&P 500.
Yeah.
And let's bring up this chart here, the S&P 500 in orange and the S&P 500 equal weight index in purple, and you see a 30.63% return for the S&P 500, and you see a 29.5% return for the S&P 500 equal weight index. And so when you look at that, no, it's not actually the 5 stocks accounting for the stock market's return. The return is actually quite broad-based. And I think if you think about what is going on in the economy right now, with the US has got almost full employment, you've got inflation where it is, you've got earnings in S&P 500 companies breaking records. You've got retail sales going berserk, and that's why we've got inflation where it is now. And we crunched numbers. So in 2021, we had a look at all the different sectors. Consumer staples up 14%, industrials 19%, utilities 14%, consumer discretionary 27%, healthcare 24%, and I'm just going to reel these off, materials 25%. This was the interesting one for me. Financials at 32.5%, tech at 33%. Energy was the big one. I didn't realise this, but energy was up 46% during the year of 2021. I feel like that hasn't has not been spoken about enough, given how much of the headlines tech has been making. So I don't think this is a market driven by 5 stocks. Once you look at the data, it shows us that it's actually a lot more broad-based than what people are making out to be.
Yeah, and when you look at those numbers, financials at 32.5, tech at 33.7. I mean, I would have bet good money that that'd be a significantly wider margin.
I thought tech would have been higher.
And oil's up 13% year to date.
Yeah,
so that
crazy.
energy story is going to continue. I think when utilities do 14% in a year, the market's going to do quite well. But, you look at the constituents of the index and your equal weighted, comparison there, it's across the board. Financials, healthcare, not surprising, has done quite well. So, no, I don't think it's just those 5 companies that are driving it. Clearly, it's across the board, and maybe maybe this year will be different. Who knows? We've started off a bit volatile, but it'd be interesting to look at that over the last few years.
What was the S&P 500 return over the 2020 calendar year? We've got it here, 27%. So the S&P 500 returned 27% for the 2021 calendar year. And you've got the sectors that we've just covered off. A number of them have done half that, but once you start getting into materials, healthcare, consumer discretionary,
most of them are
they're
above.
on the money.
Yeah, absolutely.
At the very least, right?
Yeah.
So I think it's a lot broader than what people might probably make it out to be.
Yep.
The article goes on to say, since 1980, there have been 11 instances in which the market breadth narrowed as sharply as it did between April and October of 2021. That's according to Goldman Sachs. The S&P 500 went on to generate below average returns over subsequent 1, 3, 6 and 12-month intervals most of the time. Like, I read that and that's great, but who cares what's happening over 3, 6, 12 months?
Yeah.
And who cares if the market is cooling off after you've had tremendous returns in 2018 was a great 19, 20, 2021. You've had spectacular returns in the market.
Yep.
Quite frankly, who gives a shit what happens 3 months later?
Yeah, absolutely.
Or 6 months later?
I mean, if you look at, so if your argument is that these 5 stocks have done well and the market has, and therefore the market's going to drop. Yeah, I mean, the market always drops. It goes up, it goes down. You can't make profits consistently at the same rate year after year. Expectations get a bit higher, and therefore you have a bit of a pullback, and that's what we're going through now. So I don't think what they're saying is all that groundbreaking.
I haven't seen anyone crunch the numbers. There's a lot of headlines, but I think there's a lot more to it once you look at what's going on beneath the surface.
Yeah, absolutely. And look, that there was something I found that was similar, although slightly different spin on it. And so it was an article or information published by Dimensional, Large and in Charge. So basically, on the back of that, the theory is that never or rarely in the US have so few companies accounted for such a large portion of
This is the narrative?
This is the narrative.
Right.
And so in Australia, obviously, we know that that's not the case. Forever, the banks have been a really large proportion.
Yep.
But in the US, I had no idea. So I did a little research, looked at this chart from Dimensional, and it only goes to 2019, so it will change a little bit, but I think it won't have changed drastically. And I was honestly quite surprised when I looked back. So looking at the chart here, back in 1927, we'll look at that top line. The largest 10 stocks in the US accounted for 40% of the index. And now...
That was the peak.
That was the peak. And now 2019, we're sitting at around 25%, now sitting around 30. But, it's been as low as under 15%, and that was in the early 90s. But, from 1967 on, it's been, significantly lower than the pre-1967. The top 5 stocks there, a very similar trend as you'd probably expect. And the largest one, which maybe is more surprising, back in the 30s, the largest stock was over 10, 11, 12% of the index.
Who was that?
Which is crazy.
Was that AT&T?
Would be my guess. So looking at this next chart here, which shows the largest 10 at the start of each decade from the 30s.
AT&T.
AT&T was sitting there at the top. GM, GE, Exxon, Marathon Oil, and DuPont. So
just go back to the chart before. So the market cap weight, there's a clear downward trend as to how large these stocks form part of the relative index. There's, you could probably pinpoint and say, well, what we're going through since 17, 18 is kind of what we've been going through to the late 90s. But I feel like you could probably make that same story and narrative about what happened in the late 40s and early 50s, where we've seen that before. So, same. And you can try and make contrasts as much as you like. But I guess it does beg the question, because the pattern does look quite similar, that are we going through what we went through in 1999? Especially because it is so tech-orientated.
Tech-driven. Yeah, and look, quite possibly, if you look at the makeup of the index now, Apple, Microsoft, Amazon, Google, Berkshire Hathaway's in there, JP Morgan, J&J, Walmart, and there's a couple of others. But, it's tech at the top, and I'll call them older world companies, round out the top 10. Tech earnings over the last few years, the stay-at-home, coronavirus, that has certainly helped. Apple, Microsoft, Amazon, Google. I mean, they've all been beneficiaries of that, and so it could well be. And we've had a bit of a sell-off. Whether that is, now a bit of a 2002 through 2007 type scenario, we'll find out. But these companies are big and they're growing earnings at 10, 20, 30% a year. So there's good reason for them to be
there's a
large
reason
and doing well.
There's a reason they're sitting up there, right?
Yeah.
I just, and I don't think we've got the data here, but I wonder, and you could probably pick out anecdotally in that second chart there showing which companies are leading the decades. Like how often, if it's technology driven, like I'd like to think that you would expect technology to continue to evolve, to continue to grow, because that's just the evolution. And what we've done over the last couple of years is fast forwarded what was happening prior. Anyway, and that's the same as the property market and demographics, and where people were moving and people were living and people were choosing to live. It was always happening. It's just that we've fast forward and we're seeing a lot of that unwind now. But that second chart that you've got there, where we've got AT&T sitting at top from 1930 to up to 1970. During the 60s, dropping off, falling into second place.
Even then, 1990, it was still the fourth largest company in the US. So,
until it disappeared.
So that's 60 years.
So for that reason, I think
Microsoft
and the Apples of the world, the Amazons of the world, I think there's a long runway ahead for these companies. Netflix is not a top 10 company, far from it. But I think just that sector alone still has, if history is any guide, there's still a long way to go for this stuff.
There is a long way to go, and it's interesting the constituents sort of speak to the drivers of the US economy. Back in the 30s, it was the oils. They were up there. The old manufacturing companies were up there, and there's been this slow evolution, and now it's the tech and. Given
the tech was there with IBM, right? Like IBM's kicking in 1960. Yep. IBM was top 10 stock through the 60s, 70s, 80s, 90s, and it only dropped out in 2010.
Well, after 2010, yeah, that's right. But it's about the only one there.
Is Kodak a tech company?
Well, maybe back in the day it was. But I think also
you got Xerox in there.
The stability of pre-1970, the stability of that top four versus the last 40 years. There's no instance where any company, Microsoft might be the odd one out there, where they've held their position in that top four over such a period of time, or 10, 20 years. So
I think that's a good point, and I don't know how relevant it was or how this was playing out back from the 30s, 40s and 50s, is that a lot of these companies now are so cashed up, your Apples, your Microsofts, your Amazons. If these guys sniff out any company that's emerging, whether it's private or public company, they just buy them out.
They do.
And they don't even need to use the cash. They could just go issue debt, right?
And in the current market.
2%?
That's over 2%, with Apple growing their earnings at, 30%? very little risk there. And a great example of that is, Facebook trying to buy Snap. Snap said no, so they just go and replicate what they're doing.
So and I think for that reason, I think the runway is still quite long from here on in.
Yep.
But we're just going through a period, I think, whereby we're just digesting what's going on, and we're just responding to a environment where we're just not going to be sitting on zero interest rates forever.
The ground's shifting under our feet. No one knows where it is. No one knows where it's going, I should say. And uncertainty. Investors hate uncertainty. No one knows how many rate rises we're going to get. Who cares about the next month or two, the next 12 to 18, 24 months? And, once that becomes a little more certain, once we get those first couple of rate rises, I would expect markets will start to settle. There'll be a bit more clarity. We'll be a few more quarters down the road for inflation. And, all going well, this settles, and those winners can keep winning.
What are you looking at on your next chart?
So the next chart here is really just looking at companies after they first become part of the 10 largest stocks. So they are, let's say they're Amazon, they're not in the 10 largest companies, they now have kind of grown to be in that category, and then their return relative to the index following in the next 3, 5 and 10 year period. So
after they become a top 10
after
stock.
they become a top 10. So the first one there, following becoming a top 10 company, on average, companies have returned 0.7% above the index
for
over
3
the
years.
next 3 year period. But as you can see, it gets harder and harder to achieve.
Why does it get harder
returns.
and harder? Because you're so big, or
Law large numbers? I don't know. I mean, I guess if you look at historically, and obviously,
or is a lot of the growth has already been captured? That's how you got into the friggin' top 10, right? That's where the biggest growth is.
Yeah, possibly. But going to your point about tech companies, their cost of capital, their cost of goods sold is a lot lower, so their profit margins are a lot higher than they have historically. So if we go back to the previous chart, the 30s, 40s, 50s, 60s, these companies, AT&T, GE, GM, all had a really high cost of producing their product. Whereas now we fast forward, we've got a much lower cost. For Apple to produce their iTunes music library, it's a much lower cost per dollar that they charge. And so those profit margins are higher. And so maybe this is more historical than what it will be going
presumably
forward.
Consumer stickiness, if you like, on these subscription-based models is
much higher.
Yeah. And for much longer as well.
You subscribe to Netflix or Amazon or whoever it is, month in, month out. You only buy a car from GM once every however many years. So obviously the constituents are changing, the makeup is changing, but it's just really interesting that it gets harder and harder to sort of outperform the index the larger you get.
Yeah. Let's move on. I want to talk about the Nasdaq and the pain in the Nasdaq that we've been seeing. The correction's now been extended to about 14.5% over the last 63 days. This is from Bespoke, which makes it already 10 days longer than the average post-GFC correction. And it's just 12 days short of the average correction seen in its own history going back to 1970. And so if you bring up this chart from Bespoke, which looks at the Nasdaq composite, which has 2,500 stocks, which makes up the index, and it line by line, it goes through the 10% plus down months. And so on the far left, for those listening and who can't see, we've got November 1973, August 74, March 1980, go right through the tech wreck, through the GFC, and we've got January 2022 with a 12% decline in the index. What it then shows is what the following month's return was after a 10% plus decline, what the following 3 months was, and the following 12 months was. And if you look at the very bottom, what this is basically showing us is that when the Nasdaq falls 10% plus or more in any given month, the probability of a positive return the following month is sitting at 50%. It's a coin toss, right?
It's all over the place, yeah.
And then you've got a 59% probability, or historically, of a positive return 3 months following and 12 months following. But I feel like this is really clustered around the tech wreck that really just brings those numbers right down.
Yeah, I mean, you look April 2000 through Feb 2002. I mean, that's the majority, if not all, of the negative returns, bar one, for that 12 months on.
So let's look like if we look at an example, look at September 2000. In September of 2000, the Nasdaq was down almost 13%. The month after, it was down 8%. 3 months following, down 32%. 12 months following, it was down 59.19%. Like that is. I don't know how many people would have been able to sit in their seat and ride that roller coaster down as fast as it was going.
Yeah, and and it extended. So if you did manage to ride that down, it just kept going.
I think the thing lost like 80%, 85%.
Yeah, I think so. And, companies like Amazon, which I think they dropped 90-odd% during that period. Look at that business now, but you'd be kicking yourself if you sold out. You'd be
so to all those people that say, I wish I bought Amazon in the 2000s. Yeah, so do I. Yeah. But I genuinely don't think you would have held on. You would have unbuckled that seatbelt, mate. You would have
hit the ejector seat and you'd be flying out.
You're
Absolutely.
out, man. There's no way you would have ridden that downtrend.
No,
but I think that's the thing, right? I don't think you see spectacular growth without the spectacular declines.
It's that risk return. You can't get outsized returns by taking on little risk. So you've got to take on that risk. You've got to ride it out. The other thing, Rob, I found really interesting in this chart is the number of months where there's been a negative 10% return over the last 20 years. It's baffling, that there are so few. What
is it, like 15 months?
Probably not even that many. I mean, Feb 2002, 3, 4, 5, 6, 7 over the last 20 years. And once you get past Feb 2002, every 1 month, 10% decline, 12 months later, the market was up by varying degrees.
So it's 6%, 10% plus months down over the last 20 years, 6% of the time.
I mean, that's nothing.
It's pretty extraordinary. It doesn't happen that often.
No, and does that speak to inflation in interest rates, do you think? And the type of businesses and the
I don't know, like if you look at the 90s and late 90s, early 2000s, the thing that I think that that I feel like is probably one thing that doesn't get talked about often enough is where interest rates were back then.
Absolutely.
And if you're sitting at 5, 6, 7% interest rates in the late 90s, early 2000s, compared to zero now, we talk about real rates of return. And if you want to talk about real rates of return, look at your yield now on your risk-free rate of return. You put inflation in that, and you are guaranteed to lose money.
Backwards,
right?
Absolutely.
And so I think what's been happening now, I don't think we can discount, is people's burning desire to just make money. And people are happy to roll the dice. Why would you take a guaranteed loss versus rolling the dice, and you might lose your money, but you might make some money as well? I know where I'm gonna go, and I think most people have done that. They've rolled the dice, they've taken the risk, and this is the other side of it.
There is no alternative, right? That was the mantra, and I think that's what Reserve Banks wanted, the wealth effect. And on this next chart, Rob, you've got percentage of companies in the index that have dropped more than 50%,
that's the other thing that's been
crazy.
Talked about now. Bloomberg had an article talking about the number of Nasdaq stocks down 50% or more is almost at a record. So Sentiment Trader had this chart which shows the Nasdaq. So let's bring this up. The Nasdaq composite in black, and you can see it going up and down. It's been going up since the GFC. And at the bottom, it's showing the percentage of stocks down 50% from its 52-week high. And you can see the black horizontal dotted line, and it's just clicked 40%.
Yeah, I don't know.
But have a look at the GFC, right? The COVID crisis was sitting at 60%.
Yep. I don't know how they judge they're almost at a record, because
it's not almost a record. I think the headline's misleading. If you go back to the GFC, you've got almost 80% of stocks that are down 50% from their all-time 52-week high.
Which, interestingly, was worse than the tech wreck. The tech wreck peaked out at
what are we sitting at? 55,
almost 60,
58 percent.
Significantly less. So it's interesting, and maybe that speaks to The breadth of the market, the quality of companies coming into the market and when they are in their life cycle, with IPOs coming in later, more higher priced, the unicorn IPOs. I think all of that potentially feeds into it a little bit, but it's a high number than much higher than I expected.
What are you saying? Are you saying that companies coming into the index that are of higher quality and have, whether it's wider moats or greater earning stability or whatever it may be, compared to companies coming into the market? Or
think about Airbnb. 20 years ago, they would have come into the market at a much earlier point in their life cycle, at a much lower valuation, with their established customer base would not have been anywhere near as high. But they come in now with multi-billion-dollar valuation, and 100 billion, I think it was when they listed. And so they've got a very established market presence. They've got established customer base. They should be able to ride out that cycle, and that earnings quality should be a bit better. And I think that's across the board. Yeah.
People are raising capital at, you've got D round, E round, F round. Like, how many rounds do you have to go before you go public? But I think the other thing is companies don't have to go public anymore.
No, they don't. And I think that's one big thing that has changed. And, the venture capitalists, etc., can get into these things a lot earlier. They've got a lot 100%. More money as well. So they're happy to keep funding it at ever increasing valuations. When it comes to public markets, a good chunk of that early growth is already done.
You and I were talking about this before with IPOs, and we're just looking at some of those numbers. And I think you were curious to know whether IPOs were at their lowest point for that fact.
For that reason,
the numbers don't support your argument. So for the full year 2021 was an all-time record with 1,058 IPOs.
What was the year before?
The previous record, which was in 2020, of 480.
So it's more than double.
More than double. And the lowest point since 2000 was 62 IPOs.
Yeah, I mean, there was the old...
Sorry, since 2000 was in 2009 with 62 IPOs.
Wow, okay.
And that was at the bottom of the market.
Yeah. So the red flags for a market top were always, margin lending is...
Margin lending
times above what it was.
Are they your stock picking indicators? The number of IPOs.
Well, just for the market, right? If IPOs are going through the roof, the theory was everyone's getting in before markets collapse, soaks up the money, market falls. It surprises me that there were that many IPOs last year, and even 2000. When I think what we went through in 2000.
Why wouldn't you IPO last year? Why wouldn't you? The market was...
Well, there's still a lot of uncertainty coming out of variants, vaccinations, effective.
Yeah, sure, yeah.
But 2000 to be the previous high when we went through a COVID crash, markets didn't start recovering till April, and for that to have been the previous record, that's interesting to me, and it just shows you how good times were, I think, towards the end of that year.
Let's move on. You want to talk about a couple of stocks?
A couple of high flyers, the old beneficiaries of stay at home, and there are a lot of them, granted, but I've picked on two just because it was easier. So Peloton and Netflix, two high-flying names, have done really well over the last couple of years, barring the last 3 months.
But what's happened to Netflix? So Netflix came out with earnings, right?
Yeah, so Netflix came out with earnings, and I don't think subscriber growth wasn't bad. It was the analysts had just assumed a much higher rate of growth. So,
and what's that taking into account? The stay-at-home subscriptions that were done.
I think they're just forward projecting growth,
extrapolating
2020, 2021. Yeah, right. That'll continue indefinitely because I don't know. That's the easy way to look at it. But we were saying earlier that I haven't dropped my Netflix subscription, and it'd be one.
Would you pay more for Netflix? Like, how much would Netflix price have to come up for you to go, you know what, I'm cancelling this?
I don't know. It's interesting because I think about it and go, all right, it's whatever it is, $12 a month. I don't even know. And this is the thing, I don't know. I've got no idea. But $12 a month, that's okay. That's $130, $40 a year. And I've got no context. I don't know what Foxtel used to cost, but I know it was a hell of a lot.
I remember Foxtel was like, I remember mum and dad paying for it. It was like $80 or $90 a month.
A month, yeah. So is that the ceiling?
Crazy.
I mean, it's not doesn't have the sport. But a monthly number is much easier for people to stomach.
But I think not people
over an annual.
I don't think that's the limit, because there was no other choice back then.
Well, that's true.
And so you had Foxtel. What was Ozstar? Was that like something else?
I think it was the country Foxtel.
And then you had, was there anything else, or that was it? Optus Vision.
Channel 7.
Was it Optus Vision?
Yeah, there was. That's right.
So like you had
They
nothing,
that.
but now you've got Disney, you've got Binge, you've got
Amazon.
Netflix, Amazon Prime.
Yep.
There is an abundance of choice. I don't think that bar is 80 or 90 bucks.
No, I don't think
But
it is either.
I'd happily pay today $20, $25 for Netflix.
Yeah, I hope they're not watching, but I think you're probably right. And I think, it goes up a few bucks every month. It's incremental. It's direct debited. You don't see it. It's probably higher than we think it is. And in the US, they've got a market saturation over there. So
That's a problem there, isn't it, right?
It is. And the only way they can grow their revenue now, not the only, it's becoming rapidly their only way, is to increase their price.
Although Reed Hastings came out and talked about the other areas they're trying to tap into. So gaming's one of them. I think they're already starting to get into gaming. So I feel like the Netflix business is so complex, whereby they are streaming and they've got rights to shows and movies and things like that.
They're producers.
They're producing.
Yep.
They've got subscribers. Now they're moving into gaming.
Mm-hmm.
There's just so many moving pieces to all of this.
Yeah.
And I, clearly they're best positioned to be able to manage their own business. I mean, what do I know, right? I'm not managing a Netflix, but
the data they've got is second to none.
Yeah, and even though the quality of the content is, I still probably spend, if my wife and I are going to watch a movie at home, like a good 10, 15 minutes going, what are we going to watch? So I don't think the quality is there, but I think they're going for quantity over quality, whereas something like an Amazon, the other option is Google movies. Like we do Google movies, and we'll pay $6 a movie. If there's a movie on Google Movies that we really want to watch and have a night in, we'll do it.
Yeah, right. Yeah, I haven't used Google Movies. Disney is one that we have, and I know during the pandemic, there were a couple that came out the kids wanted to watch.
Yeah.
Like, all right, one off, $20 or $30. But you're spending $20 or $30 per ticket when you go to the movies anyway, plus popcorn and Coke. So
have you been to the movies since COVID?
we have been once.
How did you?
With the kids, don't even know what we saw. But it was interesting. The theatre was probably half full, and it just felt like normal. And it was
Where did you go?
great. To Village, I think it was.
Okay.
Yeah.
So I saw Matrix at Melbourne Central. So I don't know what is that, a Hoyts or a Village?
Yeah, I don't know.
Which is all good. Like I love going to the movies. I love the smell of popcorn. But man, the seating, there was no reclining. So we didn't go gold class.
Yeah.
No reclining, and there was just shit everywhere, popcorn, and it was filthy.
Yeah.
And there's no way I would want to go into a cinema that is just got shit all over the seat, popcorn everywhere, and just disgusting, and I can't recline.
Yeah, it's interesting you say that, because now that you say that, I do recall we stood in line forever to get a drink. Yeah, there were 2 people, I think, working, it felt like, the entire
Well, I think
cinema.
that's a supply chain issue, lack of workers.
Possibly. Maybe it was a COVID issue. But it was interesting to see how few workers there were at the cinemas.
Look, I just don't think the Netflix thing's going to... I think they're not going away. I don't think
they're
Netflix
going away. No, absolutely. And the other one, I just really briefly, Peloton, completely different story in some regards, in that they've got a lot of issues that they're dealing with, and their price is off 80% over the last 12 months.
So let's bring up this chart here that shows Peloton in 2020. And you see the price just skyrocketing, right?
Absolutely.
And then literally just collapsed.
You've got such limited options to exercise. So the home was the prime candidate. You get a bike, you jump on, you get a subscription, and off you go. And unlike Netflix, there is a replaceable alternative, and that is going to the gym, running in the park, playing basketball, whatever it is. Whereas with Netflix, I think going to the cinema and Netflix sit alongside each other. They can both continue to happen. Whereas I don't use Peloton, but my feeling would be, if I've got a gym subscription, I'd rather
like a
go
membership.
there, membership. I'd rather go to the gym than in the house, kids running around, Peloton. Like, there are better alternatives when we can all get out and about. And, you know, they've had issues.
Did gyms have Pelotons? Like, could gyms use the Peloton as, you know, how your gyms have got classes and things like that? Like, would people go there and do like a group session in a gym without having to pay for the Peloton because it's kind of covered by your gym membership?
I mean, there are group classes at gyms. So
yeah, but not all the time. There are no. You go to Fitness First now. There are no group classes.
Oh, okay.
Because they don't have enough people coming in, so doesn't warrant having a trainer to come out and run a class for 2 people.
So you're saying you sit at home on your Peloton and hook into Fitness First gym, or you go into the gym?
You go into the gym,
okay.
and you use a Peloton and you hook up into their group class.
Yeah.
I've never seen that. I just wonder if that's something that's happening.
Yeah, I don't know, but that would help.
It would alleviate
Peloton out, you would think, in some regard.
Well, it'll alleviate pressure on the gym as well.
Yeah,
to the extent that they don't have to run classes because it's done for you.
Because it's all done
remotely.
But the other thing we were talking about is, you know, with this. So if I've got a Peloton bike and I sell it to you, that doesn't help Peloton other than they're keeping a subscription, but it's not a new income stream for them.
Because
you've got it and now you're subscribing.
So the ones that just the user who's changed. It's not a plus one subscriber.
So they need to keep selling new equipment to grow their revenue. And, you know, maybe they get to that point where, like, Microsoft sell the Xbox at a loss, but they make it up on the subscription revenue. Maybe Peloton need to start looking at that more, up the subscription, but lower the initial entry cost. I don't know what their options are or what their path will be, but at some point, I'm sure someone's going to start looking at this.
I think something's going to happen. I mean, even now, Reuters are reporting that you've got activist hedge funds coming in saying they want to kick out the CEO and prep the thing up for sale. Yeah. So that came out last night. So I think there's a lot going on here for Peloton, but I don't think Peloton is a reflection of the entire market. It's not even in the top 10. What's the market cap? Like 30 billion? I'm guessing.
Not sure.
So I think it's a nice anecdotal story to talk about what happened last year.
Yep.
And we've seen how extrapolating what's going on now into the future, what impact that has on stock market returns.
9.8 billion is the market cap, so it was a lot higher at some point.
Let's move on. Goldman Sachs came out talking about them busting the CAPE ratio, and so for listeners who don't know what the CAPE ratio is, it's a ratio that was developed by Robert Shiller, Nobel Prize winning economist. And basically what it is it takes price earnings ratio, which is the multiple the people or investors are willing to pay for $1 of earnings. So for example, let's say Microsoft have got a price earnings ratio of 20. What that's saying is investors are willing to pay $20 for every $1 of earnings.
Yep.
And so what Robert Shiller has done has created the cyclically adjusted, which basically takes into account the trailing 10 years and kind of averages that out.
Smooth out those.
Yeah, so you don't have the big tops and the low bottoms. Mm-hmm. And it's a ratio that is widely used by investors, by analysts, by the investing community, and it's referred to a lot. And in fact, you know, people look at it and make decisions on whether or not they should be investing in something. So what's the CAPE on the S&P 500 or what's the CAPE on Amazon? And depending on where it's sitting, they will make investment decisions on it. And I feel like when the CAPE gets really, really high, people look at it and say, look, the CAPE's really high, we shouldn't be buying. This is not a buy environment. But when the CAPE is at like 8 or 9 or 11, no one looks at the damn thing. It's like it just gets thrown out the window. But just going back to what Goldman Sachs said, we have not found any statistical evidence of mean reversion. Equity valuations are a bounded time series. There is some upper bound since valuations cannot reach infinity, and there is a lower bound since valuations cannot go below zero. However, having upper and lower bands does not imply valuations are stationary and revert to the same long-term mean.
Yeah, look, it's, I mean, you hear CAPE all the time. It's pretty interesting that Goldman have come out and said.
But they said there was a 26% statistical significance And normally with these things, we run with a 95% significance or confidence interval. This thing's sitting at 26%. So
it's pointless? Is that what you're saying?
I don't know if it's pointless. I think what it tells us is what investors are willing to pay right now. But who's to say that the numbers that we were using 20 years ago or 10 years ago were the right valuation ratios? Right?
Yeah, that's right. I mean, you look at...
Maybe we were underpaying this entire time. So relatively speaking, the number looks really, really high now. Look, I don't know. What I do know, though, is that I just don't think you can look at one thing and go, that is based on this one metric or this ratio, this particular stock or the market is a buy or a sell. But people look at that, man. People look at that. People say to us, the stock market's high. What do you mean? Based on what? Relative to what?
Yeah, and look at, he's taking the easy way out. It's like, these guys have done all the work. I just go, yep, it's higher or it's lower, it's a buy or it's sell. And, I would guess that we've been higher than the average for the last 10 years, probably. So if you didn't buy 10 years ago and you're now looking at it going, I hope I get my chance now, you've missed out on a lot of gain.
Yeah. Look, I even Robert Schiller says that it's not a tool that you should be used in isolation. And in fact, I think it tells us valuable information for now, but I just don't think it tells us, what's going to happen tomorrow or anything
point
like
in
that.
time reference.
Let's move on. Let's move on.
All right. So everyone's favourite time of year, end of year, start of year. Everyone likes to make a prediction, and certainly this year is no different. Bloomberg had put together this great article which summarised a lot of the, if not all of the investment banks. I'm going to say from around the world. There are thousands here. It's just insane. But really interesting to kind of have one place where you can get all this information. You can group it by all sorts of themes.
We'll try and share it if we can.
Yeah, absolutely. Well worth a look if you've got several days of doing nothing. There's a lot there. But, generally, the consensus is interest rates are going up, volatility will likely increase, and the markets might have a bit of a tough time of it. One thing I always think about when I read these things is, all right, so what are you going to do with this info? So let's just say Morgan Stanley, as an example, come out and say the market's going to fall 15%
well, what
in
we
2022.
Look at Vanguard have got the numbers, right? So if we'll share this, US equity return outlook is 3.3% for the next 10 years, annualized.
Yeah. So, all right. So
now
if that's the case, are you still an equity investor? Are you going to let that change the way that you look at the world? So if 3.3% acceptable,
how do you get more return?
I don't know.
We're taking more risk, I guess, right? Like what else can you do if that is?
How much more risk can you take on?
Yeah, I mean, you buy Peloton and hope
leverage
and hope the thing just goes bonkers. Can you imagine we're talking about if Nike buys Peloton. Like, I don't know what valuation they'd put on it, but the thing's worth $9 billion.
Yeah, I mean that's a quarter or two of free cash flow. So look, it's always interesting to look at what everyone's kind of saying for the next 12 months. There was a chart here, and we'll bring it up now, of the S&P 500 one-year drawdown. So the probability of a 5, 10, 15 or 20% decline when valuations are high. So the first bar there, the blue bar, is the probability of the decline, so 5%. So in any 1 year, there's a 100% probability that the markets will decline by 5% at some point.
In the bank.
In the bank.
Yeah.
Like, it's going to happen. So if volatility, you don't like it, then you shouldn't be there. And this is not a year point-to-point return. It's some point throughout the year, the high to the low of any move. The green bar is the probability of that negative 5% in this example being the return for the entire year.
So from the beginning to the end.
Beginning to the end, 23% chance of a negative return of 5% over any 1 year, or 77% chance of not getting a negative 5% return over that year. 79% chance of a 10% drawdown, 46 for 15, 29% chance for 20.
It just shows
one in three.
How much we focus on the stuff that's least likely,
Yes.
and not much time on the stuff that's most likely.
That's most likely. Yeah, that's right. So, and there's certainly plenty of research to show over any rolling 10-year period, markets will give you a positive return. So,
anecdotally, we were chatting about the 2021 outlook that JP Morgan put out at the beginning of last year, and they said we're going to have a bumpy year for stocks, which was right, but they also said buckle in because it's going to be a bloody rough ride. And I think the thing with predictions is that like you'll be right at some point, and you'll be right with one of your however many predictions that you're making. But I think JP Morgan, to their credit, got that one right, looking at historical data. But to their point about buckling, it's going to be a bloody rough ride. I think volatility is one that everyone throws out every single year. Yeah, so what are the common ones? Yeah. Volatility is one. Stocks are going to be okay.
Cautiously optimistic. That's the classic.
Cautiously optimistic.
Love that one.
But having a look at this chart, the intra-year declines versus calendar returns. So if you listen to JP Morgan
last year, look at last year right at the end there, negative 5%. That was the max drawdown from peak to trough.
And that was like in September, I think. From memory. September,
right
October.
Towards the end of the year. So up until that point, it had been an incredibly stable year. But the return was still 27%. So they got that right, as you said, but the volatility just wasn't there.
So there's 9 bars that are negative. 9 bars since 1980. So that's 41, 9. There's 25% of returns. And I think this number stands up for 100 years plus as well. 25% probability, 1 in 4 year of your return to be negative.
Yeah, absolutely.
Yet we focus so much time and energy and trying to mitigate that 1 in 4 chance.
Yep.
And I just don't think we do enough to really capture and make the most of the 3 out of 4 chance, or the 75% chance of having a positive return.
Having positive. Staying in the market, right? That's the mantra. Stay in, don't get rattled by volatility. The other thing that's really interesting to note there is, of those drawdowns, there were 2 over 20%, negative that is, 2 negative end of year drawdowns over 20%.
So what are they, 20 GFC?
What's that, 2002? So what's that, Tech, and 2008 GFC. So pretty major events that have happened to have a substantial pull down in the market. But look at all of the returns on the positive side that are above 20%. They're every few years. So, again, to your point, we focus on the decline, we focus on the loss of losing a dollar, but, that there are way more. So the market goes up more than it goes down, and it tends to go higher than, the positive returns are greater than those.
So you're saying predictions are bullshit, basically. So we're going to do our own now.
So why not? Why not add to the bullshit, right?
So admittingly, when we were putting the show notes together, we did this at the very back end of last year before Christmas. Yep. There's no evidence that supports that, but we're going to say it was, and it actually was. No, this is no bullshit. But so much has changed, but we're just going to go through the things that we were thinking about the back end of last year. My prediction number 1 was that we're going to have a bad year for stocks. I said that we're going to be down about 15%.
That's your drawdown, right? That's not for the full year, or is it for the full year? I think that's.
I don't know. I'm going to hedge my bets and just say that that's an intra-year drawdown, and I've got that right because that's kind of what's happening now. I said Bitcoin would crack 100K. I'm a long way from that at the moment. I was pretty optimistic about cryptocurrency. Sorry, not cryptocurrency, but probably more so Bitcoin and Ethereum, more so than any other.
Than most of them.
The shitty coins.
Yep.
Although that hasn't played out, it'll be really interesting to see once these interest rate rises are done. They're obviously priced in, like what happens after that. Because I think the first couple of rate hikes are going to do most of the work. And I don't think, my personal opinion is I don't think we're going to have 3, 4, 5 rate hikes, whether in the US or in Australia. That's only my personal opinion. My third prediction was that value stocks were going to outperform growth stocks. That's kind of happened, but it's probably happened more so because growth stocks are getting hammered, not because value stocks are going anywhere.
Yeah, and look, I remember when you said that one, and I did have a bit of a chuckle.
Hey, actually, the other one we said was that international stocks ex-US would do better than US stocks.
Yeah, and that was not only, but predominantly Europe and emerging markets we thought might do quite well.
Because the CAPE ratio was low.
Because that's it. So that's just what's going to happen, right? But value versus growth, I mean, it's a age-old debate. I don't know what a value stock is and what a growth stock is, but I remember back in 2014, 13, Apple was at a PE of 8. So was that a value or a growth stock? I mean, they're still growing their earnings at 20, 30%. But, through January, you're looking okay, except for that Bitcoin thing. That's not looking great. So that brings me to my predictions. So I took the other side of Rob's Bitcoin prediction. And I've gone Bitcoin will fall below 15,000 US. Now, I have adjusted that. To be fair, when we talked about this before Christmas, I think I said 25 or 30,000. I thought that wasn't bold enough, so I've doubled down and I've gone 15,000.
You're saying Bitcoin's going to halve from here. I'm saying it's going to triple.
At least half. And then it might hit both.
We might both be right.
And the other one I've said is a recession in 2024 or 2025, around that period. And that's based on the premise that the Fed and Reserve banks typically are late to the party. They get behind the curve. They try and catch up. They go too hard, too fast, and don't take.
You don't think central banks have learnt?
No, because unfortunately they're human, like the rest of us, and they're completely flawed. So, no, that's my. And I've also kind of think that I'm ignoring last year, 2020's recession, because it wasn't really a recession. It was just a COVID-induced recession. Okay. I'm ignoring it because it doesn't validate my argument. So my argument is that we haven't had a real recession for a long time, 10, 12 years. The excesses have built up and they've continued to build up. Borrowing is still really high. Margin lending I referenced earlier, and home loans and all that. So you get a few rate rises and I think people start to feel the pain. So they're my predictions.
All right, well, we'll look back onto it in a year's time and see where we land. Let's move on to final segment for the show where we'll talk about favourites, stuff that we've enjoyed, watched, seen, been to previously.
Well, you've just been away, so you've probably got a few.
I've had summer, and the thing that I've discovered was, and before I say it, just don't judge me, alcohol-free beer.
Too late. You're already judged. What's the point? Just have a Coke.
No. So the first one I had was a Squires, and they sell it at Woolies because it's got absolutely zero alcohol, so you can just buy it at Woolies, right? So I tried that one, and after the first, it's like this tastes sort of different, but I haven't had a Squires for a long time, so that's maybe how Squires tastes. And then second or third, mentally I thought I was mentally thinking I was getting drunk, but it's just this thing playing on you.
Your wife's like, come on, man. You're drinking alcohol-free beer. What are you doing?
But then I had a Heineken. The Heineken was pretty good. It was almost on the money of a Heineken. But the last one that I've discovered is Heaps Normal, XPA. And it's bloody good. And they sell them in tinnies. I did feel like a bit of a bogan drinking tinnies, but it kind of, I don't know, like for me, if I'm somewhere on at a barbecue or at someone's house, even at home, like if I know that night I've got a bit of work to do, or next morning I'm going to go cycling or something, I've got to get up early.
Yeah.
Dude, I can't be asked having a hangover or just having that beery, just groggy head and just feeling shit and seedy. But you can still enjoy the cold, crisp beer without the downside.
Without the fun.
No, man, you still have fun. You don't have to have alcohol to have fun.
That's what they tell me.
So, like for me, the XPA, the Heaps Normal XPA, and I think they just got nominated as number 20 in the top 100 at the Gabs Beer Festival Number 20 for beer, but they're not alcoholic, so a bit of controversy.
That's all right for a soft drink. That's pretty good. Well, speaking of beer, so as you know, gluten intolerant and have a hell of a time finding good gluten-free beers. And up until this summer, I thought they didn't exist, but I'm going to call them local. They're O'Brien's out of Wendouree, Ballarat. And their pale ale for any beer, let alone gluten-free.
Zero gluten, 100% enjoyment.
Fantastic.
So how'd you find it?
So Dan Murphy's.
Oh, Dan Murphy's, okay.
Did all the research and said, do you have gluten-free beers? And they're like, we've got, what's the Mexican one? Corona. It's low in gluten,
right.
but not technical gluten-free.
Right.
So I go, well, what have you got that's gluten-free? And they showed me this one. And
is it expensive?
No. I mean, you always pay a little bit more for something that's not run-of-the-mill.
Yeah.
But I wouldn't say it's expensive, but it's damn good. So O'Brien's, if you're listening, I'm open to sponsorship. No, it's really good. And for anyone that's gluten-free out there, definitely give it a go. They've got a lager, a pale ale. I think they've got a couple of others. As well.
Cool.
A brown ale.
Well, Heaps Normal just came out with a lager as well. So when XPA lagers just come out. And you know what I reckon is really cool about these things? Like a bunch of guys or girls who've come together, found a contract manufacturer, brewed it, bottled it up, got some good creative behind it, some good marketing.
That's great.
And I think it's really cool to be able to support local people and local businesses.
Yep.
And, you know, it's not cheap, but retail sales are high, so let's support it, right?
Inflation, man. Inflation. No, and I agree. You know, it's nice to support the little guys and give them a go.
All right, let's wrap it up. We'll be back again next week with a ton of new topics, talking about what's going on in markets. See you next time.
All right, cheers.